OpenAI lost roughly $38.5 billion last year. Not revenue, not spending, losses. And somehow that number still undersells it, because leaked audited financials show the company's actual operating loss. The number that strips out one-off accounting noise from converting out of nonprofit status sat at close to $21 billion on just $13 billion in booked revenue. That means OpenAI spent more than $1.50 for every dollar that came in the door. And even that ratio is being generous, because $17 billion of it went to a single vendor, Microsoft, just to rent the computers. Now, if a normal company posted numbers like that, its stock would get vaporized and its CEO would be updating his LinkedIn. Instead, OpenAI is worth more than $850 billion, just raised over $100 billion in a single funding round, and has quietly become so structurally important to the entire AI economy that regulators, economists, and its own chief financial officer have started using a very specific phrase to describe it: too big to fail. So this is the setup that should confuse you. A company hemorrhaging cash on a historic scale is simultaneously being treated like a systemic risk to the broader economy if it stumbles. Both of those things are true at once, and figuring out how that's possible is basically the whole story of what's happening at OpenAI right now. Let's start with the money, because the money is genuinely deranged. OpenAI has committed to roughly $1.15 trillion in infrastructure spending between now and 2035, spread across 7 different vendors. $350 billion to Broadcom for custom chips, $300 billion to Oracle for cloud capacity, part of a deal that alone commits OpenAI to paying $60 billion a year for 5 straight years, $250 billion more to Microsoft, $100 billion to NVIDIA, $90 billion to AMD, smaller checks to Amazon and CoreWeave on top of that. This is the Stargate project, a $500 billion build-out of data centers across Texas, Ohio, and beyond. And it is, without much competition, the largest peacetime infrastructure commitment any private company has ever made. For context, the Apollo program cost the United States about $288 billion in today's money, spread across 13 years. OpenAI is trying to outspend the moon landing on server racks before the decade is out, and it's worth pausing on what that money is actually meant to buy, beyond just bragging rights. The flagship Abilene, Texas campus is already partly live, and it's meant to eventually house over 450,000 NVIDIA GPUs under one roof. Politicians in these towns love announcing projects like this because the construction phase employs thousands of people pouring concrete and running cable. The uncomfortable follow-up is what happens once the building is finished. Estimates on the permanent, ongoing headcount needed to actually run a data center like Abilene sit at around 57 people, 57 jobs, guarding a facility that's supposed to anchor hundreds of billions of dollars in regional economic promises. That's not a knock on the technology. It's just a reminder that $1 trillion infrastructure build-out doesn't necessarily look like $1 trillion once you're standing in front of it. Here's the part that should make you nervous, though, and it's not the size of the number, it's who's on the other end of it. NVIDIA is investing up to $100 billion into OpenAI. AMD handed OpenAI warrants to buy up to 10% of AMD's own stock for a penny a share, in exchange for OpenAI committing to buy tens of billions of dollars worth of AMD chips. Oracle's entire stock valuation now leans heavily on the OpenAI contract holding up. So the people supplying OpenAI with the chips and cloud capacity to survive are, in many cases, also its investors, meaning OpenAI is being financed by the very companies it turns around and pays. Critics have started calling this circular financing, and the risk is straightforward. If OpenAI's revenue growth doesn't keep pace with its spending, the losses don't stay contained inside one company. They ripple through NVIDIA's earnings, Oracle's stock price, and a chunk of the broader market that has been quietly pricing AI infrastructure spending in as a permanent fixture of economic growth. Which brings us to the too big to fail conversation, and this is where things get genuinely uncomfortable. Back in November, OpenAI's CFO Sarah Frier suggested the company might look for a kind of federal backstop to help finance its infrastructure build-out. The backlash was immediate enough that Sam Altman personally walked it back within days, insisting OpenAI wasn't seeking a government bailout, and that if the company failed, the market, not taxpayers, should sort it out. But the fact that the question got asked at all, and that regulators at the Bank of England and the IMF have started drawing dot-com bubble comparisons to the whole AI infrastructure build-out, tells you something. When the suggestion of a government backstop for a private company doesn't sound absurd anymore, that company has probably gotten a little too load-bearing for comfort. Now, before this turns into a full eulogy, it's worth giving OpenAI its due, because the bear case isn't the whole picture. Revenue is actually growing fast, not just in absolute terms, but in efficiency. Gross margins climbed from 33% in 2025 to 39% in the first quarter of 2026, which suggests the company is genuinely getting better at serving each dollar of demand for less. Annualized run rate revenue crossed $25 billion, up from $20 billion just a few months earlier. And on the enterprise side, OpenAI claims something like 93% of Fortune 500 companies now use its products in some form, up from around 80% in 2024. That's a company still finding new pockets of paying demand, even while it burns cash, which is a very different story than a company running out of road. But you'd think a company burning this much cash while triggering systemic risk conversations would at least be running away with the consumer market it created. It isn't. ChatGPT's market share has been sliding for over a year. It held something close to 87% of the chatbot market in early 2025. As of mid-2026, most trackers put it somewhere between 45 and 68%, depending on how you measure it, and every single point of that decline has gone somewhere specific. Google's Gemini, which crossed 750 million monthly active users on the strength of Gemini 3, and Elon Musk's Grok, which went from under 2% market share to over 15% in about a year. ChatGPT still has more users than everyone else combined, somewhere around 900 million to over a billion depending on the week, and that's not nothing. But the story used to be that OpenAI had an insurmountable head start. That story doesn't really hold anymore, and internally the response has reportedly been described as a code red with ad rollout plans delayed so the company can refocus resources on just making ChatGPT itself better again. Then there's the corporate structure, which somehow makes all of this messier. OpenAI started life in 2015 as a nonprofit with a mission to make sure artificial general intelligence benefited all of humanity, not shareholders. Getting to $1 trillion infrastructure commitment on a charitable mission statement is obviously not going to work. So OpenAI spent 2024 and 2025 trying to convert into a fully independent for-profit company, freeing it from the nonprofit's control and lifting the caps on investor returns. Elon Musk, a co-founder turned open rival, sued too. Block it, arguing OpenAI had abandoned the mission he helped fund. A jury trial got scheduled. The attorneys general of California and Delaware started asking pointed questions. Dozens of former employees, ethicists, and even some Nobel laureates signed letters warning that stripping out nonprofit oversight would remove basically the only real check on how the company develops increasingly powerful AI systems. Facing all of that, OpenAI backed down. Sort of. It scrapped the plan for full independence and instead converted its business arm into a public benefit corporation, with the nonprofit now rebranded as OpenAI Foundation, retaining a roughly 25% stake and nominal control. Watchdog groups like Public Citizen immediately called this a half measure that entrenches the exact same leadership with even less accountability than before. Since there's no evidence the nonprofit board has meaningfully overruled OpenAI's management, even once since Altman's brief chaotic ouster and reinstatement back in November 2023. So OpenAI now operates with a governance structure specifically designed to reassure regulators, while critics on multiple continents argue it changes almost nothing about who actually calls the shots. Layer talent turnover on top of that. Co-founder and former chief scientist Ilya Sutskever left. Founding researcher Andrei Karpathy left. A steady stream of senior safety researchers have walked out the door, several straight into the arms of competitors like Anthropic and xAI. The kind of exodus that's hard to spin as anything other than people who built the thing deciding they didn't want to keep building it there. So where does that leave? OpenAI, it's the most recognizable brand in artificial intelligence, still comfortably the market leader by raw user count, sitting on more committed capital than almost any private company in history, and genuinely growing its revenue base faster than most companies its size ever have. It's also losing tens of billions of dollars a year with no profit expected until 2029 at the earliest, financed in part by the same companies selling it the chips, watched nervously by regulators wondering what happens to the broader economy if the bet doesn't pay off, governed by a structure nobody outside the company seems to fully trust, and bleeding both market share and senior talent to rivals who didn't exist as serious threats 18 months ago. None of that means OpenAI collapses. Companies have run enormous structural losses for years while building durable businesses, and ChatGPT's usage numbers alone still dwarf almost anything else in tech history. But the idea that OpenAI is untouchable, that its scale alone makes failure someone else's problem, was always doing a lot of quiet work to justify $1 trillion in promises. The next few years are going to test whether that idea was actually true, or whether it was just the most expensive kernel of truth Silicon Valley has ever gotten overexcited about.